Over the last 5 years, I've been consistently pulling in $30,000 a month. I've made as much as $15,000 on a single trade, and I've built a whole community of hundreds and hundreds of students where I've taught them how to do the exact same thing. And in this video today, I'm going to give you the complete roadmap on how to start trading in 2026 and eventually scale to 10, 20, even $30,000 a month. So whether you've been trading for a couple years and you can't seem to become profitable, or it's your first time ever looking at a chart, this video can and will help you. And because this is going to be very long and in-depth, I'm going to separate it into multiple parts, and I'm going to leave timestamps in the description below so you can skip to the parts that are most relevant to you or whatnot. We'll cover the core reasons why over 99% of traders are never profitable, how to read a chart even if you've never looked at one in your life, the exact setup that I trade every single morning to pull $30,000 a month plus more. The simple checklist that I run before every trade so I never gamble, the psychology of trading, the one trade a day system that lets you be done by 9:30 a.m. Central Standard Time every single morning, and how to pass your prop firm evaluation, and the exact step-by-step guide that takes you from opening your very first chart to pulling your very first payout. So lock in, because this is going to be a lot. But if you understand and actually apply everything that I teach you today, it's literally impossible to fail. It's that simple. And before we start, I put together a free guide that you can download in the description to follow along with this whole video. It's got the checklist, the cheat sheets, and the exact step-by-step roadmap for the session liquidity model so you can follow along as we go. So grab that below, hit like, and subscribe so you don't miss any more of the bangers that I've got coming, and let's get right into it. Now, although right now I'm standing here with hundreds of thousands of dollars in trading under my belt, it wasn't always like this. You see, just a couple of years ago, my life looked completely different. You see, when I was a freshman in college, that was when I started diving down the rabbit hole of trying to really improve my life. I knew I was in college and I knew I was meant for something more. I just had that gut feeling that I could be more and do more. At the time, I was working at a grocery store at HEB. I was pushing carts for $7 an hour. It wasn't nothing crazy. I was a part-time worker and a part-time student studying finance at Texas State University. And I knew that the trajectory that my life was headed wasn't the life that I actually truly wanted. What did I do? I went to the internet and I literally typed in how to make money online. I found a bunch of different things. I found Amazon FBA, I found drop shipping, I found real estate, wholesaling real estate. I found a whole bunch of things that all promised me the same thing. And I'll be real, I tried all of it. I started drop shipping, I started Amazon FBA, I started reselling shoes, reselling AirPods. I did everything that I could to make money online. And then all of a sudden, I began to see stocks online, people buying and selling stocks. And I told myself, bro, no, this isn't for me. I'm not trying to hold, I'm not trying to retire when I'm 60. That's not really what I'm worried about right now. But they said, no, you can buy and you can sell stocks within the same day and you'll make money if you're right about the direction of the market. And little did I know at the time, I was like, it's only up or down. And you're telling me if I implement some type of strategy, I can make some money? Hell yeah, man. That was when I got introduced into day trading. So when I started trading, I was doing it completely wrong. You see, I understood that to trade, it requires capital to trade. So what did a broke college student like myself who had no access to capital actually do? I lied. Yes. So what I did was, at the point in time, I had access to FAFSA, student loans money. And what they would do was they would give me loans for my housing, my rent, and to fund my education in school. Because remember, I was in university, Texas State University, studying finance. So what did I do? If I needed about $5,000 in student loans money to fund maybe my rent and some food for the semester, I usually always asked for 10. If I needed 10,000, I would ask for 20. And just like that, I started racking up a debt with financial aid, all for the purpose of depositing the money into the markets and learning how to trade. Now, That entire money is completely gone because guess what? I blew the entire money. And during the process of taking out student loans money, blowing it, rent money, blowing it, funded accounts, live accounts, everything just being blown, going down this rabbit hole of not being able to figure this stuff out. It had been like 2 years at this point, just going down the rabbit hole. I decided to do something that I had never done before. I decided to give my trading back up to God. What I did was I went down to church one day when I was at home. I went down to church. I knelt at the altar and I prayed, Lord, I've been at this for a while. I've been doing this for a while. I just can't seem to make this work. The lifestyle that I'm envisioning, the life that I want, what I really want to do with my life, I think day trading can really help me get there. If it is your will for me, Lord, please help me be a better trader. And in doing so, I will give my life back up to you. I will give testimonies of the fruitfulness that you have done for me in my life. I will share this story with as many eyeballs as possible so I can always lead any aspiring trader right now back up onto God. After I made that prayer, what did I do? Now I was walking with the Holy Spirit. I was filled with faith. I started implementing systems. I started backtesting real data. I started journaling correctly. I started honing my craft. Instead of gambling, I stopped using student loans money and I started working for my money and depositing hard-earned money into funded accounts and doing things the correct way. About 2 months later, I go down to church again. My sister invites me to her church. We go to the church and usually, when you're new to church or something like that, they always ask you, hey man, if you're new to the church, signify by raising your hand, and they usually want to complimentary things and pray for you so you can stay in your church and be part of your congregation. So I raised my hand. They took me to the back of the church and the pastor asked me, do you have a prayer request that you're believing God for? I told him no. I don't have a prayer request I'm believing God for. He looked at me and he said, are you sure? Let me speak to you after we're done praying. All right. After we're done praying, he pulls me to the side and then he looks at me word for word, verbatim. The Holy Spirit wants me to tell you, yes. Your life will be a living testimony. You shall win souls for his kingdom through the works of your hands. Your success shall spread across the lands. I said, what? Me? You already know I was cheesing, gums and I was showing. I was smiling like, God said I'm going to be rich. But this is true. This is all true. I was cheesing ear to ear. 6 months later, I was profitable. Now, was it God that made me profitable? Partly. But what actually happened was the systems I started implementing because of the confidence I had in my ability to succeed. I had spiritual confirmation that I will win. Now, all I had to do was just implement it and put in the work to win. And that is what I began to do. So what changed? I stopped looking for a better strategy. I stopped guessing in the markets. I started implementing these systems because I was moving with a level of confidence that most traders don't even get to have in your day-to-day because I put Christ first. And what happened? I started passing my first funded account. Hold on, I even have it right here. My first ever funded account. I framed it. And I know. Usually when this account definitely got blown, but when you pass your first funded account, it's always good to frame it because it's showing yourself proof of concept that this stuff is real. Don't get attached to it because the reality is that when I was still broke in uni, all I wanted to do was to start trading profitably and start making more money, or so I thought. I thought that if I pulled higher and higher numbers, I would become happier and happier. But what it took me long to realize, and what I want you to now waste another second on, is that all this was never about trading or money. And until you understand that, you'll keep seeing red months after red months. It was never about trading. Let's really think about it. Nobody actually wants to sit at a chart and look at candle screens all day, every day. It is one of the most boring things to do. You're just looking at candles on a screen. Think about it. If there was no money attached to it, why are you trading? You wouldn't. Exactly. So the point being is that You didn't actually fall in love with trading. You fell in love with what trading can do for you. Seek ye first his kingdom of God and his righteousness, and everything shall be added unto you. You see, all you were looking for was an escape from your reality. You got handed one script your entire life. Go to school, get a job, trade your hours for a paycheck for 40 years, invest into the S&P 500 and hope it's enough. Nobody ever showed you another way. You're doing it by yourself. You're looking for a way out. You need to escape the rat race, and that's exactly what you are trying to do. That's exactly why you're watching this video. It was never really about trading. You just want to be free, and I get it. But you have to understand that the whole game is to stop believing that money only shows up when you show up. That's trading your time for money. I'll be completely honest. There are workers, 9 to 5 hard earning workers, putting in more time, effort, and energy into society than I am looking at candles on a screen, and yet I am still making more money than them. Why? Because the whole game is to stop believing that money only shows up when you show up and start building one skill that pays you, whether you're at a desk or not, whether you clock in or not, whether you're on vacation or not. And for me, that looks like gas prices going up, and I didn't even notice. How much is gas now? $70, $80. Maybe you pump $20 to save money, but you know you want to pump a full tank. But the economy affects you. What about taking vacations whenever you want? Being done before most people even start their day with your coffee. You see, that's not even really about being rich. It's about being free. For example, I just went to Vegas on a random Wednesday. Why? One of my partners called me and said, hey, can you fly out to Vegas next week? Next week. And I was able to book my flight ticket, pay for the hotel, bring my girl along with me, and it didn't even affect me. Or what about the random conversation of my girl telling me how Xcaret, Mexico is so great? I mean, I've never been. Do I care to go? Not really. But she says, baby, we should go. Come on, baby, we should go. And when we went, that's not being rich. That's just being free. I didn't have to tell my boss that I want to go on vacation. I didn't have to put in PTO hours. I didn't have to check my wallets to make sure I could afford it. That's not being rich. You simply want to be free. Because if you're stuck in a job that you don't hate, but you also don't love, come on, let's be real. We've all been there. This is about buying back your time. And trading is just the cleanest way that I've found to do it. So now you know what's actually on the table. But here's where you've got to be careful, because this right here is the Mariana Trench of trading. It's where everyone dives in, all of them dead sure that you're about to start making money. I was exactly like that too. And sure, a few do for a little while. You make a couple dollars here and there, but over 99% quit before they ever become profitable. So if that percentage is that high, literally almost all of them, 99%, then why is this even happening? And more importantly, how do you make sure that you're not going to be a part of that and guarantee you make your first trade profitably and even scale to $10,000 a month consistently? 99% lose. That's the honest truth. Because every time you place a trade, there are 3 people in the room with you. There's you, right here, retail trader with the smiley face, ready to make some money in the markets. Ignore my drawing. And then there's a broker. Think of him like a middleman, right? His job is to collect your money and help facilitate orders between you and the very third person in the room. That is big money. Okay, that's big money. Think of it like banks, hedge funds with positions huge enough to actually completely move the market. So here's what this actually means for you. You are the smallest guy in the room. And big money knows exactly where people like you put their trades. So they push price right up to the spots where you have your stop losses clustered, which I like to call liquidity, just to take you out, and then they go in the opposite direction. That's not bad luck. That's simply just the game. You see, and nobody teaches you that you're up against people with billions of dollars in the markets, trillions sometimes of dollars in the market that can actually move these markets. So nobody teaches you, and you spend months, even years, trading completely blind against people who can see your trades. They can see what you're doing in the markets and know exactly what you plan on doing. They have access to tools that you can't even fathom. So how do you win? But look, here's the part that stings the most. You see, even once you understand all of that, big money versus small money, you, retail trader, once you understand that big money is against you as a retail trader, it's still not the reason you lose. Because the real reason, the one that nobody wants to admit, is that your biggest enemy is not the hedge funds. Your biggest enemy is not the broker. Your biggest enemy is yourself. That's just the honest truth. Now, I am going to come back to that because beating that version of you is the single biggest difference between everyone who makes money and everyone who blows your account. But even if you beat it, it still won't mean anything if you can't actually read what's in front of you. So let's start there. This is how to read a chart from complete scratch, even if you've never opened one in your life. Let's do it. Trading fundamentals. It all starts with these two candles. It starts with your bullish candle and your bearish candle. So bullish candle, depending on what color your chart is, usually your chart will come defaulted as green or red, and for psychology reasons you can always change that later in the future, but I don't want to get into all of that right now. Let's try and understand what this bullish candle means, and we're going to go over to a chart and I'm going to show you a real life example on the chart. So a bullish and a bearish candle. A bullish candle usually has an opening price. The opening price is exactly what the word says, the price exactly when the candle opens, and then candle anatomy will always come down and put in a low, which we like to call this line here a wick. This line here is also a wick. Once we understand that, we know price opened, came down, put in a low, which is the wick, and this has now become the lowest point this candle ever was. Then it expands upward, closes here. But what did we just discuss about what this is? This is a wick, right? So because this is a wick, that means this was the highest point this bullish candle ever was. And then it rejected and closed down here. Boom. You have a bullish candle. Just completely do the opposite, but for bearish. A bearish candle will open here. It will put in a move up here. This is now its wick. This becomes the high of that candle. It'll expand lower all the way down here, which is the low. This is now also a wick. And then it rejects and closes back over here, which is the close. That is simply candle anatomy. Bullish versus bearish candles. Boom. So this is an example on the Go chart. And can you spot the bullish and the bearish candles? And I know it's a little bit tricky because my candle colors are different. But as you know, a bullish candle goes up, a bearish candle goes down. What do you see over here? These consecutive candles, these candles right here are all bearish candles. And these candles here are all bullish candles. Let's see why. Let's take a look at this candle right here, right? It's a bullish candle. Right here will be the open. This will be the high, the low, I'm sorry. This would be that expansion upwards. You already guessed it. This will be the close. This is the high. I know it doesn't look, it's not the prettiest, but you can tell, you can see it, right? Low of the candle, candle open, expansion upward. This is the close. This is the high. Let's look over at a bearish example, for example. This one is cleaner. You can see it. Open of the candle, high of the candle, expands lower, close of the candle, and this, it has a insy tiny wick, but this is the low of the candle. Ignore my handwriting. And that's it, guys. That's literally just how to tell the difference between a bullish candle and a bearish candle. Ignore my handwriting. Let's move on to the next subject, where we're going to be going over how to actually spot market trends. So now that we've gone over how to spot a bullish candle and how to spot a bearish candle, now we need to go over how to spot a bullish trend versus a bearish trend. So now, using the context of what we determined about what makes a bullish candle, can you kind of estimate what makes a bullish trend? A bullish candle is when price is going up. So a bullish trend is when price is consistently trending upward, while a bearish trend would be the exact opposite of price consistently trending downward. So what is a trend generally made up with? A trend is made of higher highs and higher lows. That's to show you that price is consistently heading in an upward direction. So you have a consecutive, like bullish candles all going up. You can have some bearish candles coming down, but at the end of the day, we're still trending upward. High, low, high. That's the general concept of a bullish trend. And then what's a bearish trend? A bearish trend is just going to be in the exact opposite. So a bearish trend is just consecutive bearish candles trading lower. You can have some that go up, but at the end of the day, we're still just consecutively going lower. Down, up, down. Once you do that and you've learned those two concepts, trend analysis is what this is called. Bullish versus bearish trend. You use that with your understanding of a bullish candle versus a bearish candle, and now you're starting to see the bigger picture when it comes to understanding these markets. So I want to show you an example of that on the charts. Okay. So now that you know what a bullish trend and a bearish trend is, let's actually go over on the gold chart and see for ourselves how we can spot these. Let's start with a bullish trend, right? So we can take this leg, for example. It started from over here. The candle expanded upward down here. It put in a new low right here, expanded all the way up here, put in another low here, expanded here, put in a low here, and expanded here. Upon doing this, let's move this over to the side. What do we see here? We are clearly making higher highs, higher low, higher high, higher low, higher high, higher low. Congratulations. That is a bullish trend. Okay, now let me take this off our screen here. What about a bearish? What about a bearish trend? Let's start from over here. We had a high, price came down, put in a low. We put in a higher low, a lower low. We put in another low, put in another lower low. And what can we estimate? That price is going to put in a new low. If you look at this, let's move this over to the side. What is this? Lower low, lower high, lower low, lower high. That is the difference between a bullish trend and a bearish trend. Okay, we've gone over bullish candles versus bearish candles. We've gone over a bullish trend versus a bearish trend. Now, how do we actually use those understandings to our knowledge to understand what price is doing next? This is what I like to call break of structure versus a change of character. So a break of structure is aligned in a bullish or a bearish market. So all a break of structure is that once price has put in its high, and then it's putting in its lower low, price needs to break structure here on the next move higher. So let me show you an example. Price put in a high, it put in its lower low. This structure here, this high, needs to be broken for price to continue going higher. A change of character is completely different than a break of structure. A change of character is when price is continuously trending. Oh my goodness. It's when price is continuously trending higher, And then all of a sudden, there's a disruption in that trend. This is now what you call a change of character. We can expect price to now switch its bias and switch its trend to going lower. So now we're now putting in lower lows and breaking structure to the downside. Let me show you an example on the charts. For example, on the charts, it happened right here in this very same analysis that I'm showing you. What happened? Price was going higher. And then what happened? Break to start going lower. Let's really dissect this. What really happened here? So we were in a bullish trend because we're putting in higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher high, and all of a sudden, instead of putting in a higher low, we put in a lower low. So this became our change of character. And then we started putting in lower highs, lower lows. This now here became our break of structure. That's how you're able to determine what trend the market is moving in and when all of a sudden there's a shift in trend. So after I see this massive bearish candle to the downside, breaking, changing character here and breaking structure back to the downside, I can now assume that the trend has switched from bullish now back down to bearish. And the last thing that I want to go over on the basics on how to genuinely read a chart is the concept of price being fractal. So, for example, right now I am on the 4-hour time frame, right? And on the 4-hour time frame, if we wanted to take a look at this leg on the 4-hour time frame, what's going on? We are bearish on the 4-hour time frame. So, if you go down to a smaller time frame, you have to understand that each of these candles is 4 hours worth of time. If we drop down to the 1-hour time frame, I'm expecting to see 4 1-hour candles in this one 4-hour candle. If I drop down to the 2-hour time frame, I'm expecting to see 2 2-hour candles in one 4-hour candle. And if you keep doing that, you'll notice that price is fractal all the way down to the 1 second. I know some people trading the 1 second, 30 seconds time frame. You don't need all of that. It gets extremely complicated the lower the time frame you go. But for example, in this 4-hour time frame, let's drop down into, let's say, the 1-hour time frame. In the 1-hour time frame, you can notice that looking at this red line here, this is still the area that we're looking at. What is still happening? Price is still going down, higher, down, higher, down, higher, down, higher, down, higher. We are still in that bearish trend downward. If you want to take it a step further and you want to drop down to, let's say, the 5-minute time frame. On the 5-minute time frame, now that you're in, you see we have many more candles on the 5-minute time frame, but we are still consistently following the trend downward because you have to understand price is fractal. So, recap, in a 1-hour time frame, you're going to have 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60. You're going to have 12 candles in a 1-hour time frame. In a 12 5-minute candles in a 1-hour time frame. If you can scale it all the way down to a 1-minute time frame, we're going to have 61-minute candles in a 1-hour time frame, and so on and so forth. But at the end of the day, if price is trending, which is why that is what we discussed first, and that is why that is what I taught you how to do first. If price is trending, you can always use the trend to determine where the market is going, regardless of what time frame you're in. This is the 5-minute versus the 1-hour versus the 4-hour. Price is still consistently moving downward. It doesn't have to be complicated. The trend is your friend. And trust me, I know it feels like a lot, but everything else that I teach is going to be built directly on top of this. So bear with me, and we're about to start diving deeper into the sauce on how to genuinely make money in these markets. So now that you know the fundamentals, you can read a chart and you can spot the trend. But now, how do you actually know where price is about to go next? Because that's the entire trick in learning how to trade. We need to know exactly when to get in instead of gambling in these markets. And that is exactly what I am about to show you. Now we're about to get into the nitty-gritty of trading, and this is what I like to call draw on liquidity. So your draw on liquidity, hands down, is going to be the number one most important concept when it comes to trading. If you don't have a draw on liquidity, then you actually have no idea where the market's going. You don't know anything about the market. You can't create a bias. You can't validate an entry. Why? Because you have no prediction of where the market is going to go. So think of draw on liquidity like your map. Without a draw on liquidity, there's no direction. You have no map, means you're running around in circles, and more than likely, you're simply just gambling. Okay, now how do you find your draw on liquidity? It's simple. Your draw on liquidity is going to most likely be somewhere where obvious stop losses are currently being held at. Why? And what types of areas could this include? Okay, so we know prices like to move in higher highs and higher lows. High, low, high, low, high, low. So if you are trying to enter into a trade, for example, in this very same uptrending market condition, you can estimate that because we are bullish, more than likely we're going to continue being bullish and continue going higher. So where could be your most obvious draw on liquidity? Well, anybody who entered into the markets trying to catch a trend reversal and put your stop losses above this high, more than likely this is your draw on liquidity. So your job is to try and catch a trade somewhere down here. This is your stop loss with your TP here to estimate continuing with this higher high. That's it. A draw on liquidity is simply finding the areas that price is more than likely being drawn to in order to continue going higher or lower or ranging, whatever direction the market is currently going in. Okay, now what are types of draws on liquidity? You have higher time frame highs and lows. You have higher time frame imbalances. What is an imbalance? An imbalance is simply just a fair value gap. You have equal highs and lows. You also have your previous days highs and lows. My very, very favorite as well, what I'm going to be teaching you in this entire course module as well. One of the many, many draws on liquidity, but hands down one of the most important draws on liquidity, you have your session highs and lows. The backbone of the entire session liquidity model is based on session highs and lows, which is to show you the importance of having a draw on liquidity. More than likely, every single day when you wake up, a draw on liquidity is going to be one of these options. Your job is to figure out which one it is, capitalize on it, find an entry before that draw is met to then catch a trade to that draw and secure your profits on the day. Now let's hop into the chart and I'm going to show you some examples of different draws on liquidity. All right, for example, let's take a look at this clean gold chart right now. So from what we discussed about earlier, we are on the 5-minute time frame, right? On the 5-minute time frame, what is gold currently doing? It put in a high, it put in a low, it put in a higher high, it put in a lower low, it put in a higher high. At this very point in time, gold is bullish, right? What can we see can be a potential draw on liquidity for price to continue going higher? What just happened right now? This here, Gold came down and swept some liquidity and started trading higher again. What could more than likely be the potential draw on liquidity? This is exactly where we're at right here. We came down to take out this low, which we call a liquidity sweep. More than likely, this high is our next draw on liquidity. What high is this currently? This is the session level high. So this is London's high, London sessions high, right? This is London sessions high. We've determined that London sessions high could more than likely be our draw on liquidity. We've gotten some type of liquidity sweep, and now our target can be anywhere past this draw on liquidity. Boom. If we play it out, TP was hit almost perfectly. Why? Because we're trading with the short-term trend and we're able to find our draw on liquidity. If you want to go over to a higher time frame, I want to pick randomly. I want you to be able to spot this. Let's do this randomly. Scrunch this all the way down. Go back and boom. Boom. I'm able to find a nice, perfect little trending market for us right now. What do we know about trends and how do we know that trends move, right? We know this is a downtrend. Lower low, lower high, lower low, lower high, lower low. If we are trading, right, and we are in this leg here, and we've come up to put in a lower low, where would our next draw on liquidity be targeting? We want to continue with this trend. This is our draw on liquidity to continue going lower. Once this happens and price comes and puts in another lower low, where is our next draw on liquidity? It's right here. This is all back to the basics of what I taught you about trends. We do this. Where is our next draw on liquidity? Right here. We want to keep following the trend and using these draws on liquidity until price tells us otherwise. And once you drop down into smaller time frames, you start to notice that these draws on liquidity tend to be session levels. What happened here? Price drew to this blue line. What is this blue line? Sweep. Asia sessions low. Where is our next draw on liquidity after taking this blue line? London session low. Let's make this cleaner for you. What are we currently doing? Down, up, down, up, down, up, down, sweep right here. Where could our next draw on liquidity be? Low. We are expecting to continue going lower. What is aligned with that low? London sessions low. Which is why your draw on liquidity is very, very important, because simplified, it's just pretty much where you're expecting price action to go. You're not really looking for your entry signals. We're going to cover all of that in later subjects. Your draw on liquidity is simply just trying to teach you where you're expecting price to go. And more than likely, if you are a good trader, where you're expecting price to go should be aligned with the trend. So when we are downtrending, your draw on liquidity should be lower. When we are uptrending, your draw on liquidity should be higher. Now, we are going to cover the main topic, the main reason why you're here. The session liquidity model. And the first thing I want to make clear is that this is not another strategy. It's a complete rule-based system. The whole thing is built around one idea. The market moves from session liquidity to session liquidity every single day. So how does the market even run? The market runs in session. So we have Asia session, we have London session, and we have New York session. And each one leaves behind a high and a low. These highs and lows are exactly where liquidity lies, and price always comes back to hunt them. So when you are trading, you have to mark out your previous session opens. The New York session opens at 7 a.m. The New York session is the session that I trade, but you have to understand that this model works in any session. You can trade the Asia session, London session, or the New York session. I trade the New York session, so the example I'm going to be showing you will be on the New York session. So the market opens at 7 for New York session. London session, I am in Central Standard Time. So what you can do is you can come over here to where it says UTC -5, and you can follow along with me and then change it back to your time zone, and it'll be marked out exactly where your time zone is. New York session starts at 7. Asia session, it's at 19, and London session is at 1 a.m. Once I have these 3 levels marked, it's as simple as that. Now I have my Asia session, I have my London session, and my New York session is about to start going forward. So every single time you're about to trade, whether you're trading the Asia session, if you're trading the Asia session, then you want to mark out your New York session open, and you want to mark out your London session open. If you're trading London session, you want to mark out your New York open, and you want to mark out your Asia open. And because we're trading New York session, we're marking out our Asia open, and we're marking out our London open. Once you do that, you simply go in and you mark out the highs and the lows in each session. So for Asia session, this is the high, and this is the low. This is the low right here for Asia session. Why is this the low for Asia session? I don't care if on the 1 hour it's not actually a low. It has to be the lowest point. It has to be the lowest point that price came to the. It has to be the lowest point in the entire session. It can't form a high. It can't form a low. No. If we go down to the millisecond time frame, the lowest point in that session, that's the Asia session low. The highest point in that session, that's the Asia session high. We can do the same thing for London session. London session, this is the highest point in London session, and this is the lowest point in London session. If we drop down to the 5-minute time frame, now we have a better understanding. What I like to do to make my life a little bit easier is I'm going to go ahead and share this special indicator that I use to currently mark out my session highs and to currently mark out my session lows as well. It makes it so much easier for me to do that because I don't have to worry about drawing it out every single session. So I'm going to give it to you completely for free. All I ask is that y'all make sure you like and subscribe to this channel. And this is the indicator right here. It is called ICTQ Zones and Pivots by TFO. You can go ahead and copy my settings. This is the exact settings that I told you about using the American/New York time zone. Show Q zone boxes. Asia, I set it at 22. London to 8. New York AM 9:30 to 11, which would be 8:30 for me, and all of that. Show pivots. This is all the settings that you need. Go ahead and pause the video and then just go through this. Boom. Once you have that, now you have your Asia session low, you have your London session high, and you have your Asia session high. I set it to show me the three previous sessions. So I have this session that I'm currently trading, then the previous session levels, and then the previous session levels. So usually you should have 4 session level lines on your screen, but I usually have like 8 because sometimes price will react to other session levels further down the line, which is a whole different advanced concept. So right now I just simply want us to focus on these session levels. This is Asia session low, this is London session high, this is Asia session high, and this is London session low down here. Cool. Now, what do we do next after we've marked out all these session levels? It's simple. I wait for price to sweep one of those session levels. It has to grab the liquidity at those session levels, and the second it reverses back to the downside using my entry trigger, that's my signal that the move is about to happen. So On this price action leg, so on this leg here to the downside, price is currently in a downtrend. We've already gone over how the market moves. Low, high, low, high, low. I wanted to do something like this and continue going lower. This is what I like to call a sweep of liquidity. Tap in our Asia session low. This is a high right here. Now we simply just wait. Click, 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 click. What does price do? It comes, taps our level, immediately displaces lower. What do? We get into a short position, stops above the high that tapped our level, lower. Because what does price like to do? Price likes to move from session level, Asia session low, to session level, London session low, and TP hits. Just like that. Just like that. Because anyone can pull up an indicator, but this is different. You're actually watching what the big institutions, what big money is doing around these levels that most traders don't even mark on your chart. Let me show you something cool. What happens the moment we hit London session low? Recovery. Price starts moving higher and then eventually goes lower. Okay, let me show you another example. Here. What happens? This is Asia session low. This is London session low. We are in a downtrend. What happens the moment we come back into this level? We continue to move lower to follow what? This downtrend. High, low, lower high. What can we expect? Lower low. Where is it reacting out of? Our session level. Where is it going? Lower. This is how the market moves. A lot of people are not teaching you this. They want to cloud your entire judgment with a whole bunch of different concepts. Order block, this, candle wick theory, orb strategy, this. The session liquidity model in its simplest form is all you need. You're simply just waiting for one specific thing to happen at one specific time. And when it does, you snipe it. So I want you to take what you just seen. Take this indicator that I gave you completely for free. Take this indicator, go into your chart, put it into your chart, and just go back. Pick a random day. Let's do it together. Let's go back. Let's pick a random day and see if these session levels get reacted from. Random. I don't know where it's going. Boom. Select bar. Cool. Now we're random. Let's drop down to the 5-minute time frame. Boom. What is this? Asia session high. Tap Asia session high. Go higher. We're in a drastic uptrend right now. Let's see if we get something. We're still in London session. New York session opens. What does New York session do? Go higher. What is this, guys? We picked a random day. What is this? London session high. What does it do at London session high? Grabs London session high, dumps. Where is it going? Probably London sessions low. Boom, London sessions low. The market likes to move from session levels to session levels. Once you understand this and you learn how to build a bias around this, which I will be teaching you in the next lesson, once you learn how to build a bias around this, it becomes so easy. It becomes so predictable to know and predict what you want this market to do. And then you simply add the rules. One trade a day keeps the 9 to 5 away. We're going to go over all of this. I don't want to overwhelm you at this one specific time, but I want you to see how easy, how systematic we can really get your trading to be if you just lock down this concept of session highs and session lows. Go into your chart, take this indicator, practice with it, and see where the market is continuously reacting from. This is the exact same system, the exact same model. Everything that I just showed you in the previous clip, the exact same system and model is what I taught Yobesh. Yobesh went from an inconsistent, unprofitable trader to pulling $15,000 every single month. I am not joking, and I am not pulling your leg. $15,000 a month. Right now, Yobesh is actually on vacation, traveling the world. He said he was about to hit Spain and Barbados and a whole bunch of different, like, shit, I ain't even did that yet. Well, I'm just more of a work type of guy, that's why. But it's trading. You can be whatever type of guy you want to be. All I simply did was teach him this exact same model, implement it into his trading, and a year later, he quit his 9 to 5 job and he's traveling the world as a full-time trader. That is the power of the session liquidity model. But here's the problem though. That setup that I just showed you, it's going to show up all day long in both directions. And if you take every single one, you lose because half of them are traps. You need to understand and learn which one to take. So the real skill isn't spotting the setup. It's knowing which ones that you should actually take. And that comes down to one thing before you figure out whether you should press buy or sell. And that is your bias. All right, your bias. Your bias is simply just your read on where price is most likely headed that day. No bias, no trade. So every single morning when you mark out your session highs and your session lows, we can do that right now, like I taught you to do in the previous lesson. Boom. Market opens at 7, we mark that out. Market opens at 7, we mark that out. Then we have London session that started at 1, we mark that out. And we also have Asia session that opened at 19. We mark that out as well. And when you're determining your bias, you have to look at what the previous session did, what we are currently doing, and where we could potentially go. So you're going to ask yourself 3 questions. 3 questions. And if you can answer 2 out of the 3 questions, you then will be able to answer the 3rd question, which means you can answer all questions. First question, where are we coming from? So let's look at this. Where are we coming from? Let's look at the most current price action leg. We put in a low, we put in a higher low, and then we put in a break. This looks a lot like a change of character like we discussed earlier in this video. Okay, then we put in a high, and then we put in a lower low. This looks a lot to me like bearish momentum. This is where we're currently coming from. Now, let's get a little bit more niche on where we're currently coming from. What is this here? This looks like we have swept some liquidity to go to the downside. So that's currently where we're coming from. We are in a bearish leg, and it looks like we've swept liquidity higher to continue going lower. Where are we currently at? Right now, we are currently in the middle of putting in this distribution leg, and we have currently taken out this low. So what has happened? So we're not confused. Price has swept liquidity. We've came down and we've taken out this low. And one thing that you need to understand about liquidity, if you haven't learned it in the past, is that price can do one of 2 things at liquidity. It can either A, reverse, or B, retrace. So if I'm expecting bearish momentum, I'm not expecting price to reverse here. I am expecting a small retracement, which then we can use to advantage to answer the last question. Where are we going? Where are we going is a pure estimated guess. Nobody knows. But this is how we use finding the draw on liquidity, which we obviously know that the draw on liquidity should be lower right here. If we're planning on continuing this bearish trend, the draw on liquidity is lower, but we have swept a high, so I'm expecting this high here not to be touched. We are now in the middle of sweeping a low, and I know this low can give us some type of retracement. Where could we retrace to? We are on the 1 hour. This is where you now mark out your 1 hour balances. I can estimate that price can do this. Boom. Congratulations. You have formed your daily bias. So notice how in the daily bias, we haven't used any form of session liquidity levels yet. Because your daily bias is not revolved around your session liquidity model. After we have found our daily bias and we are believing that our daily bias should react here, we've created some type of narrative, we can now drop down to the lower time frames and start seeing what our daily bias aligns with. This is that 1 hour time. This is that 1 hour zone that we marked. Do you want to see what's inside this 1 hour zone? What is this? Asia sessions high. Now our trade looks even better. We want price to come up, sweep out this high while tapping Asia sessions high, the session liquidity model, reacting from this 1 hour zone and going lower. Boom, we have created our bias on the day. Now that we have that story, your job right now is that you only take trades that line up with that story. If your bias says up, you're only hunting for buys. And the second price does something that it doesn't fit, you don't do anything, you wait. So for example, in this situation right now, all we're simply doing is we're waiting for price to go do exactly what we want it to do. Tap, displace lower. If you didn't catch this one, it gives you a second entry. Tap again. Where are we reacting out of, guys? Asia's session high. Tap to displace. To go lower. And this is that low that we are expecting. So let's go back out to the 1 hour time frame. And did price do what we wanted it to do? Yes. Sweep came lower. This is that low we were talking about. It went up, reacted to where we wanted to go. And what did it do? Hit our draw on liquidity. That's it. That's how to form a bias. And this one habit alone is the difference between catching the clean move of the day and getting chopped to pieces, taking random trades all over the place. Daily bias. Now, if you've made it this far, that already tells me that you're actually serious about this. And that puts you ahead of 90% of the people who clicked on this video. And if you'd rather skip the years of figuring it out alone like I had to, and instead have the whole system handed to you with live calls every week and a room of traders running it alongside you, that's exactly what we do inside the Day Trading Accelerator. So if you want to learn more, I'll leave a link in the description to book a call with me and my team. So all right, you've got your bias, you've got your setup, and right about now, you're probably feeling ready to click buy. But although rushing in this second looks good, it is exactly how most people lose. Because there's one last thing that I run every single trade through first. It's a dead simple checklist that makes sure every trade you take is one that actually wins. And here's how it works. This is the exact checklist that I've run before every single trade I take for years. And if just one of these is missing, I don't take a single trade. That's it. So this is the day pre-trade checklist. One trade a day keeps the 9 to 5 away. Before I look for anything, in my window, I'm trading the New York session, and automatically I have an end time. By 9:30 a.m. Central Standard Time, if I have not taken a single trade, I am done for the day. Before I even create a bias, before I create any of that stuff, I need to know what time I am stepping away from the charts. After I do that, I now need to check, is the day worth trading? I don't trade bank holidays. I don't trade FOMC. I don't trade CPI days. I trade PPI days if it's worth it for me. So that's like a little bit iffy, but very, very high impact news days and very, very low impact days when it's a bank holiday, I simply do not trade. That is the very second thing that I am looking at. Third, have I used my one trade yet? More than likely, you haven't. If you traded the Asia session market, if you traded the London session market, then you have. But if you're coming in and you're trying to trade just the New York session, there we go. Not trading the open. On NASDAQ specifically, I will go in and I will mark out the time zones from between 8:15 to 8:30 Central Standard Time, because that is when the market opens up for me and I'm not looking to place any trades by that time. Keep in mind, I haven't even created my bias yet, but I'm adding fail safes for different things that I know I should not be doing when I am trading before I even start trading. Why? Because my mentality, my mindset, my mental right now is always going to be way sharper than the mental that you have while you are trading. So make sure you do all your hardcore rules in the moment, then and there, before you start looking at placing any other trades or before you start looking at actually diving deeper into the market. Boom. Now that we've done all that, we can start with our bias. That's the very first thing I do, right? I use the 1 hour time frame, and if I'm confused on the 1 hour time frame, then I can go ahead and drop to the 4 hour time frame. I ask myself these 3 questions. Number 1, where are we coming from? Number 2, where are we now? And number 3, where could we go? I can also use the fib. And how I use the fib is that I drag the fib from the high that swept liquidity down to the low that has broken structure. And I usually find my OTE zone, which is the 0.618 to the 0.786. Boom. After I have done that, that fib is to determine where could we potentially go. Where are we coming from is determined by the trend. That is why that was one of the very first things that we covered together. How to spot the trend. That will answer the very, very first question of where are we coming from. Where are we now? That is where this last one comes into play. You have to understand something about price action. If we are trading below a high, or if we are trading above a high, or if we are trading below a low, you can expect one of two things. Either A, reversal, B, retracement. So once you've been able to answer those 3 questions, then you'll be able to answer where could we go? And where could we go is the whole purpose of finding your draw on liquidity. Then you drop to the 5-minute time frame, and we're gonna go on ahead because all of this is in this pre-trade checklist. Step number 2, session levels. Now you can start marking out your actual session levels after you have created a bias. A lot of you get the session liquidity model backwards. You start marking out your session levels before you create a bias, and then you try and create a bias using session levels. No. Session levels is just an entry trigger on what we already assumed the market was going to do in the first place. We're just using session levels to give us a stronger draw on liquidity or a stronger reaction to take us to where we need to go. So we have to mark out our session levels, make sure that it's not a random spot, and it has to align with either our OTE zone, higher time frame gap, has to align with our bias, has to align with the trend. The session liquidity level that we're looking to trade from has to align with the bias that we literally just created. Boom. Step number 3, no sweep, no trade. That is a non-negotiable. You have to make sure that the level that you're looking at, the session liquidity level that you're looking at, has to be swept, has to be tapped, and it has to start displacing in the direction that you want to trade it in. It's the right sweep After you get the sweep that you want in your direction, now you're looking for IFVG. You can either take this on the 3-minute time frame or you can take this on the 5-minute time frame. What you need to understand about price action is that obviously the higher time frame holds more power. So the 5-minute entry will always be better than a 3-minute entry. But once you get that clean first IFVG after the sweep, you can either wait for a good retracement if your inversion is too high. So you can actually set a limit order at exactly where you want to get into your trade, and then you can target higher levels. But if your IFVG is below the session level or above the session level and you're looking to trade in the opposite direction, you always need to wait for a candle closure above or below your session level. And another thing that you have to make sure is that your setup didn't take forever to inverse. You have to make sure that it didn't take forever to inverse. We need V-shaped recoveries. That is a sign of displacement. Boom. Once you have all of these situated, next you can do your entry and your risk. You can either take it on the break or you can wait for a retracement back to your IFVG. Stop should always be at a protected level. Go for a 1-to-1 default, targets the nearest level, and break even only when price taps a future level. This is the rule. If all boxes in this list is checked, that was a good trade. If one box is missing, you are gambling. This is what keeps you from throwing money at a setup that was only ever going to lose in the first place. I want to show you something, right? This is one of my students, Les, that joined the program using the pre-trade checklist. And this was his P&L. He had red days, but his green days severely outweighed most of his red days. But look what happens the moment he stopped using the checklist. Can we speak sometime? I think this is getting to me in trading. It's about tilt. I said, sure, let's do Zoom or phone call. We did phone call. He said, hey, Day, it's been a minute since that phone call. And after going back to my older habits, implementing the checklist that I built out for him, the very same checklist that I showed y'all in this video, my understanding of money further and some back testing to reinforce the behavior, it's been such a smooth ride back from recovery. I've even implemented a hard money stop loss on all accounts as a secondary safety to protect against tilt. I'm about 2 to 3 days away from fully recovering from that tilt behavior, assuming you're all green days, but now I've got the extra things helping me stick to it. Boom, just like that. Glad to see that I was able to help using and implementing the exact same framework in this pre-trade checklist that I built for y'all was the same thing we implemented for Les, and he was able to recover and stop tilting. So that's the whole system on the chart. Now, remember, that enemy I mentioned at the start, the real reason why over 99% of traders quit before they ever become profitable. Now that you know more about trading than most people teach you inside your paid programs, we can finally talk about what it is and how you beat it every single time so you can actually trust yourself to execute when real money is on the line. You see, there are two types of people who sit down at a chart. There's either a trader and then there's an operator. So a retail trader, the ones that make the reason 99% actually lose, they're usually emotional. He's glued to every tick. He gets cocky when he's winning. He tries to get revenge on the market when he's losing. And his whole mood for the day rides on whether he's green or not. He ties his entire personality, his entire being, his entire livelihood back to trading. He doesn't know when to walk away. He doesn't know when to call it quits. And most importantly, he is definitely inconsistent. That is a retail trader versus an operator. An operator is the complete opposite. An operator is running a system. He has a step-by-step checklist on what he needs to do in order to be successful. He comes in with a game plan. He maps out an entire strategy before he even sets foot on the chart. A win and a loss are the exact same thing to him. It's just information. He's not asking himself, did I make money today? Did I do this today? How much am I up? What can I buy? Can I buy a new car? No. He's asking himself, did I follow my rules today? Did I implement my system? Did I follow the checklist? That is an operator. Look at the loop almost everyone gets stuck in. You win a few trades, you start feeling untouchable. So you throw a bigger size than usual. You over leverage. You're winning. You're on a crazy win streak, right? And then all it takes is one bad trade and it wipes out everything you just made. Has that happened to you before? It probably has. Or you take a loss, then you start second guessing yourself. Then you freeze up, and then on the very next trade, that was actually a good trade that should have recovered your loss and keep up with your profitability, you freeze up. You miss the actual good setup right after. And now, whether that trade won or lost, you're still in the red because you hesitated on actually implementing your system. But look, the operator doesn't live in that loop. He decides his stop and his target before he's even in the trade. And once he's in, he leaves them alone. Green day, red day, break-even day, it's all the same to him either way. Because his only job is to follow his rules, implement his system, let it play out over hundreds of trades, and let probability determine the outcome. So the number one thing that I use to help me function like an operator when I am trading instead of a retail trader is just this one thing. Once I place my trade, I set my stop loss, I set my take profits, and I have heard the order filled sign. I simply get up from my desk and I walk away. Now the trade can only do one of two things. It can either win or it can either lose, and implementing this one thing was what took me from a retail trader to an operator in literally 1 month implementing it. Now, behaving like an operator instead of a trader is simple, but it's not easy. And after over 5 years in this game, the single most powerful tool I built to force myself to act like an operator instead of a trader, it's so simple. It almost sounds stupid. And that is simply one trade a day. Why? Because one trade a day keeps the 9 to 5 away. You don't need your own money to trade real size. There are companies called prop firms whose entire business is handing you your capital, sometimes up to 6 figures to trade with. So how it works is you pay a small one-time fee, you take a quick evaluation, and all you have to do is hit a profit target without breaking your daily or max loss limit, pass it, and they fund you for real. Look, so for example, if you look over here at apextraderfunding.com, they can give you $25,000, $50,000, $100,000, or even $150,000 to trade with. And right now, they have either you can do end of day trailing drawdown or intraday trailing drawdown. They have a standard fee with a $100 activation fee or no activation fee. But if you go with the $50,000 and you use code DAY at checkout, DAE, code DAY at checkout, you can get $50,000 in funding for $24. The same $50,000 that I blew on student loans money, I could have accessed for only $24. And keep in mind, you do have to pass your evaluation, right? And this is what Apex lets you do, right? They let you trade up to 20 of those accounts. So you can have 20 50Ks or 20 100Ks, however much you want. You have to wait 5 days for a payout. It's your rule, so you have to follow your rules. It's 1 day to pass. There's no eval consistency rule, so you can pass it all in one trade. Just wait for one really high quality setup and you can pass it. 100% requested, so there's no profit split in your funded. You pay a one-time fee, no reoccurring billing, and you have multiple platforms to choose from, and most importantly, they don't deny payouts. Passing isn't about being some genius trader. It's a discipline test. Can you hit the targets that you're giving you without blowing past your own loss limit, which is the exact thing that one trade a day and the checklist that I provided for you earlier forces you to do. And there's genuinely a real method to passing fast. You have to go for smaller, high probability targets, capping your risk so the account can't blow, which is how my students pass in days instead of grinding for months. When I first started trading, it used to take me 3 months. Yes, 3 months to pass one of these funded accounts, and now I can pass it in less than a week. This is why a disciplined beginner on this system passes evaluations that wipe out traders with 10 years of experience. You're fighting your emotions all day while you're just simply sitting down and you're following a set of rules and you're hitting one clean target and you're walking away. And to show you it's real, I'm coming over here into my achievements tab to show you that all my students trade with prop firm accounts. Look at all of them. Passenger account, Lucid, passed the Lucid account. John passes Lucid account. Marcus passes 50K My Funded Futures. Riley just passes Take Profit account. Carlos just passes Apex account, the same one that I just showed you. Look at Marcus. He just took a $3,700 payout. The money is real. He took out $3,700 payouts by paying $20 to $50 for one of these funded accounts. It's ridiculous. Look at this. More payouts being secured. Look at Jack. He took a $600 payout. Marcus, another payout. Passing funded accounts. Passing funded accounts. Passing funded accounts. More payouts. Look at this. More payouts. $1,500 payouts. Locked in. $775 payout locked in to pay a small fee of $50. This is something I wish I had when I first started trading. Like I said, if you want to gain access to these funded accounts, you can come over here to Apex Trader Funding and make sure you use code DAY at checkout and you can get a 50K account for only $24.90, obviously using the coupon code DAY at checkout. And real quick, everything I'm walking through here, the session times, the checklist, the full step-by-step for this whole model, it's all inside that free guide that I mentioned at the start. And if you haven't grabbed it yet, the link is in the description and it's completely free. So go download it and follow along. So let's say you get it funded and you start pulling some trades. Here's the problem nobody warns you about. Most people who finally get profitable still end up giving it all back. And it comes down to one thing: risk management. When it comes to risk management, there are two types of risk management. There's the risk management for a live account, your personal account. There's a risk management for evaluations on prop firms. And then there's a risk management for when you're actually funded on these prop firms. And I'm going to teach you how to trade with each and every single one. On a live account, very, very simple. Never risk more than 1 to 3% of your account. I know you've heard that a lot. But what they were telling you is never risk more than 1 to 3% of your account per trade. We are saying per day because we only take one trade a day. You have to understand that the entire system, the entire blueprint, it doesn't work if you break just that one rule. You have to take one trade a day. So that's on a live account. Most of you watching this, you're planning on trading prop firms. So you might be wondering, Day, how can I pass my funded accounts without blowing it? And how can I get a payout without blowing it? When you are trading a prop firm evaluation account, I want you to divide your drawdown into 4. So what does this mean, right? If you're given a 50K account, on a 50K account, they usually give you a drawdown of $2,000. $2,000 divided by 4 will give you $500. I want you to risk $500 per trade on your evaluation. You're giving yourself 4 trades to blow the account. But Day, that's very aggressive. That's not really. 4 trades, think about it. You only take 1 trade a day. With taking just 1 trade a day, 4 trades means you have Monday, Tuesday, Wednesday, and Thursday. That's almost a full week of you losing every single day for you to blow your account. It becomes almost impossible. And if you're a beginner, it might take you roughly around 2 weeks doing 1 trade a day, risking $500 to pass your account. Versus when I started, it took me 3 months to do it. Okay, what about when you are in funded? When you are in the funded stage, I want you to take this $2,000, because that's still your drawdown. I want you to take the $2,000 and divide it by 8. In doing so, now you're giving yourself 8 chances. This is double the amount that you gave yourself in the funded stage. And you're now risking about $250 per trade. And the reason why I say to divide your drawdown into 8, risking $250 per trade, is because most of these firms, they have what we call a consistency rule, and you need at least 5 winning days of $200 or more. If your minimum risk is $250 and you're going for a minimum of at least a 1-to-1, then every single day you win, we know at the very minimum when you win, you will be making $250 per trade. And in doing so, that's really all the risk management that you genuinely need to pass these accounts. Because your only real job out here is to survive. Keep the losses small, let the winners run, and stay in long enough for the big green months to finally land. All right, so now you've got the system, you've got the mindset, you've got the funding, and you've got the risk rules. The only thing left is how you actually put it all together in a crystal clear roadmap that you can follow every single day to take small steps to making your first trade and eventually scaling to 10, 30,000 a month, and why not even higher. To go from 0 to your first payout, step 1, backtest. And I don't mean the regular backtesting like you're used to try and see if your strategy works or whatever. No. We're not backtesting a strategy this time. We're backtesting a system. You're going to use TradingView's replay tool, and you're going to scroll back through old price and make sure you don't cheat. Go back to a time that you don't actually remember trading. Go to like 2023, 2024, 2022 even, and practice spotting the setup over and over and over with zero money on the line until you can recognize it instantly. After you do that, what I also now want you to do is go to any of these funded accounts that you have decided to go with. So let's say you chose Apex Trader Funding and you use code DAY at checkout for 90% off. Take the rules that they give you for that account, which is more than likely a profit target of $3,000 without losing more than $2,000 a day, without losing more than $2,000 overall with a $1,000 daily loss limit. Implement that same rule in backtesting and see if you can consistently pass these accounts through backtested data. Step 2, forward test. Move to a free demo account and take the setup live as the market actually moves, still with no real money. You're taking 1 trade a day and you're practicing how to actually do this in real time. And you're going to forward test similarly to how you're going to back test as well. You're going to strategize how to pass these prop firm accounts through forward testing. This is the exact same blueprints that I put all of my students through. Step 3, you're ready for the big dogs. It's time to get funded. Take a prop firm challenge using the same system. You've been doing it on demo, you've been back testing it. It's all the same. 1 trade a day will help you pass these funded accounts. Hit the targets without breaching the loss limit and pull your first payout. The first money you've ever made from a chart instead of a boss. This system can help you do that. Step 4, make sure you track everything. Journal every trade, even the ones in demo. Journal it. Why did it win? Why did it lose? Why? But also journal your emotions and what made you break a rule if you did break one. Because that's how you fix the part of you that actually makes you lose money. If you took more than 1 trade in a day, why? If you FOMO'd into a setup, why? If you revenge traded, why? Make sure you journal everything, because then you're actually going to be able to dissect the real problems in your trading. Step 5, scale slowly. Add 1 funded account at a time as your consistency grows. Don't go from passing 1 account to buying 5 and trying to pass 5 this time. Never a bunch at once. Until those payouts start adding up, you have to do it 1 at a time, 1 at a time, because you're slowly going to do this right. And once those payouts start adding up to more than the paycheck that you're trying to walk away from, then you know that you're ready to start adding more and more funded accounts and more payouts. And that right there is the entire path from never opening a chart to pulling your first payout. So really, the only thing left is deciding how you're going to walk it. You see, you've got two options. First one, you take everything I just gave you, the system, the bias, the checklist, the mindset, the roadmap, and you go run it on your own. Because there's no reason why you can't. You just saw me yap for 1 to 2 hours and show you live how to make your first trade and eventually scale past 10K a month. So there's literally no way that you cannot do this on your own. But if you'd rather not spend months figuring out the messy parts alone the way I did, then you're exactly the type of person that we work with inside the Day Trading Accelerator. What we do in there is hand you this exact system, built from the ground up, get on live calls with you every week, and drop you into a room of traders taking the same one trade a day that you are. So if that's something you want for yourself, whether it's landing your first funded account, finally getting consistent on the system you're already running, or just building this into real income on the side of your job, the link to apply and book a free call with my team is in the description. Other than that, if you got value out of this free training, do me a favor and hit the like button and subscribe so you don't miss any of the next ones. Thank you for watching, and I'll see you in the next one. Remember, one trade a day keeps the 9 to 5 away. Peace.